Hello and welcome to MF Corner. I'm Sumaira Abdi. On the show today, what do the amended AT-1 of the perpetual bond rules mean for your debt mutual fund? Joining in will be Ashish Shanker, Deputy MD of Motilal Oswal Private Wealth Management. And in just a bit, we'll also talk about simplifying the process of selecting the right mutual fund with FinSafe India's Mrin Agarwal. But first, let me invite Ashish Shanker, Deputy MD at Motilal Oswal Private Wealth Management, to talk about what this AT-1 rules mean. So first up, the rules themselves. Now, about a week ago, we saw SEBI come out with rules saying that AT-1 bonds, which is a bond actually in which debt mutual funds invest money, that is called perpetual because it doesn't have any life, right? So SEBI said that it needs to have a defined duration. So let's keep that duration as 100 years. Then we had the Finance Ministry, and we should start pulling up some of the graphics also. The Finance Ministry coming back and saying that you need to reconsider these valuation norms. Late last night, SEBI has announced that they are going to provide a glide path, right? So the basic tenet remains the same, which is that these bonds will be valued as having a maturity of 100 years, but just not yet. When these rules kick in on the 1st of April, SEBI says that for the 1 year following that, value these bonds as having a maturity of 10 years. For 6 months after that, value them as having a maturity of 20 years. For another 6 months after that, value them as if they have a maturity of 30 years. And only on the 1st of April 2023, by when 2 years would be over, do you need to start valuing them as having a maturity of 100 years. Now, this is significant because currently the AT-1 bonds outstanding amount to about 90,000 crores, of which mutual funds have exposure to about 35,000 crores, right? So is your mutual fund amongst them, and what does it mean? Ashish, first, I want to understand that, a lot of the funds who have these AT-1 bonds are also defined by these Macaulay duration limits, right, of SEBI. So even if you cut down the duration to 10 years, it is still more than the 3 years or the 5 years that they were currently using, right? Which was the call to maturity. How are they going to adjust it in the Macaulay duration?
Right. First of all, Sumaira, it's always a pleasure to be on your show. And, happy to clarify some of the recent regulations on AT-1 bonds. See, you're right that most funds have a duration limit, but before we go into that, Sumaira, I think it's important to tell the viewers the difference between duration and maturity, because often we may get confused between maturity of the bond and duration. Essentially, maturity of the bond is what it is. So every bond has a defined maturity. It could be 5 years, it could be 10 years, and on that day it matures and the principal comes back to the bondholder or the NCD holder. Right? Now, duration is a technical concept. It basically tells you what is the price sensitivity of that bond. So typically, a coupon bearing bond will have a duration which is lower than the maturity. So for example, if you have a bond with a maturity of 5 years, then the duration, depending on the coupon that it pays out, could be anywhere between 2 to 3 years. Now, simply put, if the interest rates move X, let's say interest rates move by 1%, that 1% into the duration of the bond will be the change in the price of the bond. So 3 is the duration of the bond, then 1% move into 3% will be the change of the bond up or down, depending on whether rates move up or down, right? So now coming to, the issue at hand. See, although most mutual funds have a duration limit, what SEBI has also done in its revised guidelines is they have put in a grandfathering clause, which means that whatever exposure mutual funds currently have, it could be, of course, in future, you cannot have more than 10% of your fund into AT-1 bonds or perpetual bonds. But currently, even if a fund were to have 15% exposure to AT-1 bonds, it need not sell those bonds immediately. In fact, there is a grandfathering clause and there is no end date. So the fund can actually gradually bring down the exposure to AT-1 bonds. And the whole idea of doing this is to ensure that there is no immediate price disruption and hence, as a result, a negative impact on NAVs.
Grandfather your exposure, Ashish, you grandfather the exposure, fair enough. But you will have to somehow control the duration of your fund, right? If there are some funds which have 10-15%, But then suddenly that 10-15% which had a duration of 3 years or 5 years now becomes 10 years.
Right. So, see, in the interim, Sumaira, what funds will try and do is they will try and adjust it in the fund by way of a barbell approach. So, for example, for this year, that is the next coming financial year, you have to value these bonds as a 10-year maturity bond, right? 10-year maturity typically means your duration will be somewhere in the region of 5 to 6 years, right? Now, you will try and see what is the duration of the other instruments in your portfolio and try and manage volatility and duration of the fund with those other instruments, right? Because whatever I've seen, barring maybe a few funds which are small in exposure, the largest exposure for a fund is, I think, closer to 17-18%. You have all the numbers. At the bottom, it is about 3 to 4%. The other thing also, Sumaira, one needs to keep in mind is the impact is only on AT-1 bonds. It is not on AT-2 bonds, right? So a lot of funds have both AT-1 and AT-2 bonds. So you have to look at what is the net exposure to AT-1 bonds in these funds. But suffice to say that they will try and manage the duration through the rest of the portfolio. So that is my view. Secondly, Sumaira, what happens is that these bonds, they gradually go up to 30 years and then they become a 100-year bond. Now, to be very honest, there is no precedence in the Indian markets of how a 100-year bond will be valued. Now, potentially, it could be very, very volatile, right? If you take the bond till perpetuity and then calculate duration, but that is not in reality how it will get traded. Because you take the example of equity. Equity is a perpetual instrument, right? Now, in equity, you do have a terminal value. So I believe even these bonds, eventually when things settle down, obviously SEBI will come out with the valuation guidelines. They will be traded somewhere between 10 to years maturity is what I feel, because these are ultimately bonds and they have a fixed cash flow on a year-to-year basis.
Okay, Ashish, we have a query actually which has come in on Twitter from Major General Brajesh Kumar. He has written in. Now, he says that he had invested 10 lakh rupees in a banking and PSU debt fund. I don't know which, but he has chosen the direct option. Now, he wants to continue investing in debt funds. So, he's asking, perhaps because of these rules, should he redeem from here? Should he look at some other debt fund? And, that is something that a lot of investors want to know is that, if my fund has high exposure to AT-1 bonds, is there something for me to worry about?
See, the bonds have already reacted to this news. So, for example, let's say an SBI perpetual bond with the call date of 23-24, year 23-24, was trading at, let's say, close to 6.9%. And as we speak, it's closer to 8%. So in a sense, some of these bonds have already reacted negatively to this news. And I think valuations will settle down around these levels is what I feel. So if you're a longer term investor, when I say longer term, you put in the money into bond funds as a substitute to fixed deposit for 3, 4, 5 years, I don't think you should worry about it too much. You should continue to stay invested, because even though there has already been a slight negative mark-to-market impact on that part of the portfolio, going forward, these bonds will accrue at a much higher rate. Again, one caveat here, Sumaira, that people should consult their investment advisors, because I'm speaking in general. Now, different funds have different exposures. So really, it'll depend from fund to fund. But broadly, the bigger funds like a Kotak or an ICICI or let's say an HDFC who have exposures to these kind of bonds, they are generally in the region of 8%, and I think the highest exposure is 17-18%. So for these funds, really, one can continue to stay invested. But I've seen one odd fund where the exposures are closer to maybe, 40-42%. Yeah. But that's a very small fund. So there, investor is better off exiting, because the risk in that fund has really heightened quite sharply after these announcements.
Yeah, and I guess even before the announcement, right, Ashish? But, is it safe to say that now, because everybody's exposure is going to be capped at 10%, and, AT-1 bonds, by the way, were popular because they gave a higher, yield. They gave a higher return on your funds. Of course, they were a little riskier, or a lot riskier. Depends on how you want to look at it. But Ashish, is it safe to now assume that therefore returns of categories like banking and PSU, credit risk, and even some of the other funds which are doing very well because they had this concentrated exposure to AT-1 could be coming down?
Yes, definitely, because some of these funds had taken additional exposure to tier 1 bonds as a way to increase their yield. But having said that, Sumaira, till some time back, a lot of these tier 1 bond yields had also dropped. So, like I give you an example of SBI, where the yields had dropped to as low as 6.9%. But definitely going forward, given the cap and the restriction on these funds, the yields will be lower to that extent. But remember, it is impacting 10 to 15% of the portfolio, right? Remaining, the yield will be determined by how they invest in the 80 to 90% remaining portfolio as well. Yeah. But to that extent, I think this window which was available to them to bump up yields, it doesn't exist now.
Ashish, appreciate your time and thanks very much for explaining this subject to our viewers. So like Ashish said, you have to really see which is the fund that you're holding. First, find out whether or not it has exposure to AT-1 bonds and then decide whether you have to stay invested or not. And some funds, like Ashish said, the risk has gone up quite substantially. A quick break for now, but up next, we're going to talk with Mrin Agarwal of FinSafe India on simplifying your mutual fund portfolio. So how to actually get it right and keep it simple. On the other side, stay tuned.